What's up guys, welcome to Thorchain Digital. In today's video, I'm going to cover 7 infrastructure tokens that I'm stacking for next bull run. If you guys are new to Thorchain Digital, I talk about all things DeFi, all things crypto, all things altcoins. You can check out some of my previous videos if you guys are an airdrop hunter. It's literally a smorgasbord of everything crypto. But without further ado, let's go ahead and talk about these 7 different tokens that I'm stacking for the bull run. So the first one we're going to talk about is Track. The TLDR on this is it's the main indexing layer on Bitcoin. If you don't know what indexing means or what this is, just imagine a library with books all over the floor and literally just no organization. If you want to look for the Bible or look for the Chronicles of Narnia, you wouldn't be able to find these books without just like rummaging through all of them. However, when you enter Track, you now have an organized library in alphabetical order. If you need to look for something, it's simple. You just look it up by alphabetical order, pull it out, boom, you got the book, done. That's what Track does. So if you take a look at Track on their website, they're actually doing this for several different protocols and they're expanding the horizons. They're actually taking on more and more. But these guys are doing it for BRC20s, bitmaps. They're also doing this for runes, and they're going to be doing this for Pipe. Pipe is basically another form of BRC20s, except it's a little bit different on how it's stored on Bitcoin. It's not text-based, instead it's UTXO-based, so it's a little less data intensive. But without going into further detail on Track, in summary, it's kind of like the main indexing layer in organizing all that chaotic data that's on Bitcoin and making it much easier to use and for someone to call for that particular data. You can check out the previous videos on YouTube, on my channel, if you want to check that out and learn more about it. The next token is Thorchain Rune. This token is the main infrastructure layer that allows the facilitation of swaps between native assets. So this is like your native Bitcoin, native ETH, native Litecoin, native BNB. This allows the actual native swaps between these different tokens. So let me go ahead and show you what this looks like. So basically I can swap one native ETH for one native Bitcoin using Thorchain. This literally allows you to get the native tokens. We're not talking like wrapped Bitcoin or wrapped trash. That is basically a centralized token that is self-custodied by BitGo. So if you're getting wrapped Bitcoin on Uniswap, that is not actual Bitcoin. We've already seen what happens when you have, well, the incorrect Bitcoin. Let me show you guys Sol BTC. Actually, it doesn't even show up anymore. It's off peg. The Sol BTC is worth like 500 bucks right now, even when Bitcoin is worth $3,500 or $35,000. So the point is just because you have a wrapped or a pegged asset doesn't mean it's the actual thing. Thorchain is allowing you to swap for these native assets in a decentralized manner. So the only way to get actual native Bitcoin without Thorchain is to go on a SEX. You typically have to KYC, go through all that information, and purchase your Bitcoin that way. Thorchain is allowing this in a trustless manner. Now, the second part I really like about Thorchain is the reflexive liquidity flywheel that it has. So if you want to check out some of my previous videos to get some more details on how this works, you can, and you can learn a little more about this. So the TLDR on how this flywheel works is for every $1 deposited, there has to be $1 in Rune behind that. And then an additional $2 by the node to basically validate these different transactions. So let's say, for example, I deposit $1 in USDC into this pool. Well, let's make it $2 because it's got to be sold into half. So I deposit $2 in USDC into this pool. What happens is I keep one of those dollars in USDC. The other is immediately sold and put into Rune. This is thrown into an LP pool. So now it's literally a 50-50 pool. That's $1 in buy pressure immediately on Rune. So now as soon as this $2 is deposited, the TVL increases. The nodes, they must be 2x the Rune value. So if I deposited $2 into that pool, $1 of it is Rune. The nodes must have $2 in Rune to validate these transactions. So in theory, what happens is for the $2 that I deposit into the pool, there's $3 in Rune buy pressure. So as more people deposit into this liquidity pool, or into these liquidity pools, as you can see, most likely just chasing these yields. You can see USDC is paying 159%. You have USDT paying 488%, and these will be reflexive on to the Rune price. So as Rune price increases, these APRs go up. So this is kind of a bull market coin as well. It does have this reflexive flywheel, but I do like the main infrastructure token being that it's used to swap for native Bitcoin and native assets, which no other protocol is doing this. Sure, you may use some of these different DEX aggregators that allow you to get the native tokens, but they are actually using Rune as the main infrastructure layer. So that is the second token, Rune. So you can think of it cross-chain liquidity, cross-chain messaging, that is Thorchain. You can check out the main website, check out all the details in the description below. You can check it out on CoinGecko. So the next token I want to talk about is Link. This is basically the main messaging layer for DeFi. So as you can see here, the current market cap is around $6 billion. At its peak in the bull run, it was actually managing almost, it says $172 billion in TVL. It's not actually managing it, but it does have control of a huge portion of that. The reason I say that is a lot of these different DeFi protocols depend on Chainlink actually working. So what it does is it communicates with outside data and brings it on chain. So if Binance is saying Bitcoin's at 35K, KuCoin at 35K, or any of these different exchanges, the on-chain information like Uniswap, it cannot read what's happening price-wise. So Uniswap could be trading at 30K Bitcoin, or wrap Bitcoin at least. And then on Binance, it could be 35K. Or for all we know, there could be a random wick. Nobody knows. But the deal is on-chain needs to be able to communicate off-chain in order for there to not be, random cascading liquidation events. If you can imagine on Aave, Aave is thinking, okay, well, Bitcoin is trading at 35K. And that's what it's trading at on-chain. I'm sure you can imagine the situation if Aave thinks, oh, okay, well, Bitcoin's 35K, but everywhere else outside of on-chain, Bitcoin is actually trading at 25K. Well, without that communication layer with Chainlink, there's basically going to be a bunch of bad debt on Aave. And if this happens, there's going to be people that borrowed money or lent out money that won't be able to get it back. And then you can have all kinds of, not good situations. And Aave isn't the only protocol that uses Chainlink. There's actually many other DeFi protocols that use Chainlink. But the TLDR is it brings off-chain data on-chain so it can actually communicate and figure out what's going on. This is also really good for prediction markets. So let's say, for example, there's a prediction market that says, okay, Trump is going to be elected in 2024. Well, how do we actually know that data is true and whatnot? Chainlink is that oracle that provides that data. Another exciting piece that's coming with Chainlink is CCIP. It's cross-chain interoperability protocol. Basically, this is going to come into play and replace the broken network that we already have with bridges. If you guys haven't been in crypto long enough, bridges are basically the #1 hack risk. And Chainlink will be creating a better solution with this by allowing a more seamless and simplified token transfer between these different chains. Chainlink is already multi-chain, so this already has the main infrastructure to allow this. So just think, hey, I'm bringing Bitcoin from Ethereum or wrap Bitcoin from Ethereum and bringing it onto Phantom chain. Chainlink is basically going to be used as a main infrastructure layer to have that main communication layer. The good news about this and why it's better than the current bridging solutions is that you just don't have basically a honeypot full of money just stored into these different contracts, because that's how the current bridges work. People are basically providing liquidity on one chain and on another, and the bridge is actually giving different tickets saying, here's an IOU. If you're bridging from Ethereum onto Phantom, you basically have just different IOUs on chain. You aren't actually getting the actual tokens, whereas Chainlink is going to allow you to have the actual tokens there. So the token custody is not into the smart contracts. It's actually with the person itself. The next infrastructure token I'm looking at is FXS. FXS is basically the hidden hand in DeFi. If you take a look at some of the governance power that Frax has, you can take a look on DeFi Wars and see all the different protocols that they own a large share in. The biggest one that I like is Convex. Now, Convex is a huge governance token holder of Curve. They basically own Curve. For those of you that don't know what Curve is, it's basically your main liquidity layer for a lot of these different stable assets. So like your USDC, USDT, or STETH, wrapped ETH, etc. This allows you to swap between these different tokens. It just happens to be the best model just based on how their AMM works. And as you can see here, if you take a look at many of these different pools that are on Curve, what controls these different pools and what liquidity is deposited into here has to do with the CRV incentives. And these incentives fluctuate based on the voting power. Any of these different pools, they can be voted on by governance token holders, the Curve governance token holders. So you either have to hold Curve or one of these other protocols that have a large portion of the Curve voting power. So if you go under the Curve Wars, you either have to own a bunch of CRV or own a bunch of CVX CRV or even YCRV or even staked out Curve. So basically these are the different protocols that can actually vote on the different Curve pools. So Convex actually owns 50% of the Curve supply that is out there, which is a huge governance power. And that's why the value proposition is owning Convex. But the majority holder of Convex is actually Frax. So if you take a look at Frax and scroll down, they're actually right behind this guy now. But they used to be first in line, and it's the same thing with Frax. They have this governance power, and they're going to continue to accrue more CRV as well as Convex. So they're actually able to vote on these different pools, and it's considered the hidden hand because if they want more liquidity for a particular token or a particular asset, all they would do is vote on that pool, and they would get governance rewards there, which will incentivize people to deposit. So let's say, for example, I want to get 7% on some stable coins. I would be like, bro, I want to get that. So I would go ahead and deposit into here and get a nice yield. Same thing here with Frax ETH and wrapped ETH. I can get between 2.95% to 7.38, depending on what I hold. I can use Convex and get the higher end. But basically, I'm able to get that juiced yield. Whereas if I look at STETH, STETH is getting nothing. It's literally 1.77%. That's doo-doo squirts. So I can get Frax ETH, which is earning the yield in the 2.95% to 7.38, and still have exposure to ETH. So it's not like a pool 2 type of thing. And that's where the sauce comes into play with Frax. You can see here that they are actually able to leverage this to their benefit by earning or by gaining more and more ETH deposited into their Frax ETH. So here's where the sauce comes into play for Frax. They're actually using their governance power to get more liquidity for their stablecoin as well as for their liquid staked ETH product. And this is just the beginning. They're going to be rolling out more and more things. But it's able to offer the highest yield on ETH because it splits the yield up. Whereas on Lido, if you stake your ETH and you simply hold the wrapped stake ETH, you're just earning the straight up ETH yield just like everyone else. Frax actually takes a different approach. You deposit ETH, you get Frax ETH. This doesn't accrue in any value. If you wanted to earn the staking yield, you do have to stake it. But it's earning a premium rate because what they do is they actually are able to split the amount of people that are depositing into that pool by offering a pool that's FRX ETH and wrapped ETH. So if someone wants to earn this 7% yield in Curve, they're actually forfeiting their ETH yield by depositing into this pool. That ETH yield is actually going to the other people who are like, I don't want the CRV rewards. I'm going to go ahead and stake my ETH and earn that ETH or that yield in ETH. So that's how Frax is able to offer the higher incentives. And they're able to do that for their stablecoin as well. But you can think of Frax as like your all-in-one everything DeFi. So you got your swap, you got Frax Lend, you got liquid stake products, you got a stablecoin. You have everything on Frax. You even have a bridge. So Frax is just one of those main infrastructure layers. It's kind of considered the hidden hand in DeFi. If you want to learn more about Frax, you can check out the previous videos I made on YouTube. Now the next token I want to talk about is AASH. Now AASH is, in my opinion, considered the AI supercloud. Well, actually, that's kind of what it says right here. The supercloud for AI. Now, basically, this is going to be something that is the main infrastructure layer for AI development and coordination between different GPU units. So currently the main coordination would be using something like Bitcoin, and they have all the mining operations and they all go and mine Bitcoin. AASH is taking a similar approach by using the AKT token as the center of that to align people's incentives. Currently, this is one of the best decentralized options. The other centralized options would be using something like AWS or any of these huge web servers that have a lot of data processing power. So I look at AASH as like the main infrastructure layer for a decentralized cloud as well as cloud compute, and which would be for AI. And as we get further and further into the AI revolution, more and more data crunching will need to be done. So this is one that I do have on my radar and that I've been stacking for the bull run. Now the next one is SNX, Synthetics Network. This is basically the main liquidity hub for perp dexes, in my opinion. If you take a, well, actually it says the liquidity layer of DeFi. Yeah, we'll take that one. It sounds better. The total trading volume with SNX and the Synthetics protocol is $44 billion, or actually 45 billion, and counting. And this is mainly from the trading volume from some of their different protocols that they have. Just to name a few of them, you have Quinta, Polynomial, Lyra Finance, D-Hedge. So if you don't know what any of these are, Quinta is kind of like GMX. It allows you to leverage trade like Bitcoin, ETH, and different tokens. Polynomial, same junk, different day. Allows you to trade perps with leverage. Lyra Finance allows you to trade options. And then you have a couple of other protocols as well. But the main things I want to show on Synthetics is it's always cranking in on fees. Like literally every single week. If you check cryptofees.info, it will be listed as one of the top protocols here, just cranking in fees. And if you take a look at some of the historical fees and volumes it has, you can see here it has basically been constantly grinding it out ever since it dropped V2. And you can see here February 2023 to now. And even when volumes are dying down in crypto and even in a bear market, it is still putting in the numbers. You can even take a look at some of the perp dexes by comparison. This is Quinta, one of their main products. You can see it's actually a huge competitor to what? GMX. You can see here it's actually ranking in at some points in time higher levels than GMX. It may look the same chart-wise, but take a look. 200 mil here. You can see here it ranks up at 400. So at peak times, it was actually cranking in over 400 mil. And currently, it's actually coming in a little bit stronger than GMX. And if you take a look at the other ones, it's actually one of the main perp exchanges with one that is starting to rise, which is Mux. But Mux is actually a aggregator, so a bunch of these volumes are actually coming directly from Quinta. But just something to keep in mind. And also, just so you understand, Quinta is just one of the products of Synthetics. They have several other protocols that leverage the technology of SNX and the SUSD token. They even have a centralized or decentralized centralized exchange coming out. It's one of Kane's products. It's called Infinex. If you guys want to check out more information on Synthetics, just check out some of the previous videos for more details on what's going on. The last token I want to talk about is Atom. Hey Tom, the Cosmos token. Now, a lot of people look at this and like, bro, are you serious right now? Yeah, Cosmos is one of those tokens that's the infrastructure layer for airdrops. This is the main reason why I do like it, but they are actually revamping the tokenomics a bit, and they are making it for a interchain security solution. So it does have one of the higher market caps in the Cosmos ecosystem. So if new tokens launch on Cosmos, In order for them to validate transactions, they do have to have their own proof of stake network. So like AASH built on Cosmos, it has to stake its own tokens. Thorchain, same junk, different day. Luna, back in the day, people had to stake tokens in order to validate different transactions. That's basically how Cosmos works and the main infrastructure for it. If you want to learn a little more about Cosmos, check out some of the previous videos on how the technology works. But basically, Cosmos allows interoperability by making every single chain have a similar blueprint so they can basically communicate and interoperate with each other. So I can send Cosmos tokens onto Juno or any of these other chains because they have a similar format and functionality. And in the future, they're hinting at interchain security. So basically, people who want security for their chain, they can use the Cosmos token, or people staking Atom or Atom tokens can actually validate for these different chains and earn some of the fees and the swap fees from those different chains. Well, gas fees. But the main reason why I like the Atom token and Cosmos has to do with the airdrops. I'll just go ahead and go over a couple of them that happened last bull run and one that literally just happened. Last bull run, one of them was Ion. Simply just staking Cosmos, and if you voted on some of the different governance proposals, you got a couple of Ion tokens. And at its peak, it was worth $20,000. And I'll kind of rewind that. A couple of Ion tokens. This is literally just airdrop for you, like, hey bro, here, thanks, whatever. Another one was Juno. These were airdropped to the Cosmos stakers as well. At its peak, it was $40. The Juno airdrop was saucy for some people. Some people got several thousand tokens. Several thousands times 40, you can do the math. For some, it was probably a six-figure airdrop. Nita, another token. You simply just had to vote, or actually first you just had to stake the Cosmos token. But if you voted on some governance proposals, you actually got 10 Nita tokens. Like literally just airdrop, 20K. Like here, just for no reason, just whatever. Another one was Osmosis. This was a really juicy airdrop. At its peak, it was $10. If you did numbers on this, and some people got several 10,000 Osmo tokens, that's a lot of money. That's another six-figure airdrop. Then you had another one that literally just dropped. It was the TIA token. Depending on how many Cosmos tokens you were staking, this was also one of those other six-figure airdrops. All I'm going to say is don't fade the airdrop infrastructure token, Cosmos. And in summary, here's the tweet I made for all of these. You basically have Rune, the main liquidity layer for BTC native swaps. You have SNX, the liquidity layer for perp dexes. You have Track, ordinals, BRC20s, infrastructure, basically the fun stuff on Bitcoin. AASH, the decentralized cloud. Link, the heart of DeFi. FXS, DeFi's hidden hand. And Cosmos, the infrastructure coin to get more airdrops. Guys, thanks for tuning in. I hope you guys enjoyed that video. If you guys did, go ahead and drop a like, subscribe to the channel. And if you want to check out some of the previous videos, you guys can check out those on YouTube. And if you guys want to see what I'm doing in the markets and join the exclusive Discord, you guys can check that out in the description below. I share content on there that I don't share on YouTube. And you can chat with a bunch of other DeFi degens just like you. Proverbs chapter 15 verses 13. A happy heart makes the face cheerful, but heartache crushes the spirit. Be good, be righteous. Peace.